Welcome to this lecture about the economic aspects of COVID-19. Before we start getting into the economic aspects, let me start with some quotes which I have read in the book The Structures of Everyday Life by Fernand Braudel. Note that those quotes illustrate that the effects of a pandemic have not changed very much. The basic effects have not changed very much over the last centuries. So here, the first quote says, "One bourgeois from Toulouse placidly wrote in 1561, 'The aforesaid contagious disease only attacks poor people. The rich protect themselves against it.'" We also have a quote from Jean-Paul Sartre that says, "The plague only exaggerates the relationship between the classes. It strikes at the poor and spares the rich." Note what has changed is illustrated by the next quote, which says that when the pandemic was over, rich people, before returning to their carefully disinfected houses, would install a poor woman inside for a few weeks as a sort of guinea pig to test at the risk of her life whether the danger had really departed. The quotes in the books continue and highlight similar things we have seen today. For example, the same quarantine, precautions, despair, and social discrimination. Now note that what is interesting in this last sentence, it says, "No disease today, however great it ravages, gives rise to comparable acts of folly or collective dramas." Note that this sentence, given the current COVID-19 pandemic, may not be as correct. And then here, lastly, it says, "A careful observer who escaped the plague at Florence in 1637 describes the barricaded houses and empty streets, forbidden to all but food suppliers. Florence was dead, no business activities and no religious services." Note that the no business activities is something that we are going to cover today in this lecture. Now, let us have a little bit of an overview of what this lecture is going to be about. Note that I will be first giving you an introduction, and I will be talking about certain supply and demand basics. And then I'm going to illustrate those supply and demand basics with the labor market of the 1918 flu pandemic. Note that the supply and demand basics are going to be covered throughout this lecture because they are very important. Next, I'm going to look at certain macroeconomic indicators like inflation or unemployment. And then we're also going to look at fiscal and monetary policies in the US and also elsewhere to actually combat the economic effects of COVID-19. And lastly, I will be talking about certain economic developments that have been in the news over the last couple of weeks, such as inflation, housing prices, and lumber prices. Okay, and then lastly, we are also going to talk about labor shortages. So let us start with the introduction. Note that COVID-19 has vast economic consequences across all sectors, and the coverage of all aspects of COVID-19 and its effect on the economy is way beyond the scope of a single video. So what I'm trying to do is to present you with tools and examples from a subset of economic sectors. And I'm also trying to explain economic concepts which may be useful to understand the economic effects of COVID-19. One of those useful concepts is going to be supply and demand. And also, we are going to talk about the differences between fiscal policy and monetary policy. Note that the full analysis of the economic and social consequences of COVID-19 will take years and probably decades. Researchers are still disentangling the effects of the 2008 recession on the economy. Okay? So we can expect that the same will be true for COVID-19. Now, also, things to keep in mind is that at the moment, every social scientist is only at the beginning of disentangling those effects on society. Some early findings or some early research will not stand up to future research in the sense that they will be wrong or they have to be corrected. Now, the advantage of science and the scientific method is that it allows for the correction of such errors. Okay? Then second, when it comes to data sources, I will tell you what the data sources are from which I have pulled the information in these slides. And not many of those sources are actually updated on a regular basis, such as the unemployment rate, for example. Now, a very important data source that I would like to present to you right now is what is called the Federal Reserve Economic Data from the Federal Reserve Bank of St. Louis. I will be using the abbreviation FRED throughout this lecture. Note, for example, if you're interested in the public debt, you can type in public debt, you can hit enter, and you have, for example, the federal debt as a percentage of gross domestic product. Note that FRED serves as an aggregator of various data sources. So here this data comes from the Office of Management and Budget, but it is also pulled from census data or from the Bureau of Labor Statistics, etc. You also have data about international sources, and if you are interested in how the economic indicators, which I'm going to be presenting throughout this lecture, how they will evolve in the future, you can check on the webpage of FRED and see how it's evolving over time. Now note that economics is the study of allocating scarce resources among multiple users. So for example, if you have to decide whether to purchase a new computer or whether you're going to go on a vacation, then you're making economic decision, okay? Now, in the context of COVID-19, we have trade-offs as well. So at the beginning of the pandemic, there were trade-offs between detrimental health effects and lives lost and whether to shut down the economy. There are also costs to consumers, to firms, to government from social distancing, lockdowns, and other measures. Now, what we are going to see today as well, that there's also a trade-off between consumption today and consumption tomorrow. What this means in economic terms is the presence of savings or debt. If you take on a car loan, for example, today, then you are foregoing consumption in the future because you have to pay back the car loan. The same is true that if you are saving today, then you are transferring your income from today into the future. Now, in the presence of the COVID-19 pandemic, we are going to see that there are large fiscal policies which make the government spend today in order to buffer the negative effects of COVID-19, and that the spending today is going to influence the consumption of the government tomorrow because the debt will have to be repaid. Okay, so there are many aspects of trade-offs for the topic of COVID-19. Before we start to get into some economic aspects of the pandemic, let me explain first what the concept of supply and demand is. Note that on the horizontal axis, you're going to have the physical units of a good, for example, gallons of milk, and on the vertical axis, you're going to have the price of a good, for example, the dollars per gallon of milk. And in equilibrium, we have supply equals demand in the sense that the quantity demanded by consumers equals the quantity supplied by the firms. Note that if anything but the price changes, then we have a shift of the demand curve or the supply curve. Now note that the following example, I'm going to use meals at a restaurant or the market for meals at a restaurant to illustrate the concept of supply and demand and shifting curves. Let us look at the market for restaurant meals to explain the concept of supply and demand. Suppose that you have a city like Indianapolis, and in the city you have many restaurants. And you also have many customers who are demanding meals at a restaurant. Now note, let us look at the demand curve first. Here on the vertical axis you have the price of meals, and on the horizontal axis you have the quantity of meals. If the price of meals is very high, then people are going to demand a low quantity of meals. Whereas if the price of meals is low, people are going to demand a higher quantity of meals. So that is the demand side, which is downward sloping. Okay? There is an inverse relationship between the price and the quantity of meals. Now, when we look at the supply side of meals, then what we have, if the price of meals is very low, then firms or restaurants are not going to provide a lot of meals. But if the price of meals is very high, they are going to expand their quantity of meals provided. Okay? So on the supply side, what we have is we have a positive relationship between the price of meals and the quantity of meals. Where demand and supply meet, we have the market equilibrium, where we have the equilibrium price of meals, and we have the equilibrium quantity of meals. Okay? Note that in general, restaurants are a highly competitive industry. Highly competitive means that there are a lot of restaurants out there, and there are also a lot of customers demanding meals at the restaurant. And in general, because you have many suppliers or many restaurants and you have many consumers, in general, the profitability, or in terms of profit margins, the profitability is low, and you also have low profit margins. Okay? So when we start from the equilibrium condition, okay, now suppose we have now a demand shock which is due to the emergence of a pandemic. Okay? So suddenly you have people are not going to restaurants anymore. Okay? So what this means is we have a shift to the left of the demand function. Okay, so now we have the demand during the pandemic. Okay. So what you can see now is that we have a new equilibrium price, let's call it P double star, which is smaller, and we also have a lower equilibrium quantity. Okay? Now note that because it is a highly competitive industry and because we have low profit margins, since now we have a decrease in the price, restaurants do not find it profitable anymore to stay in the market. Or in the sense that because they're now making a loss, they are not able to survive and they're leaving the market. So when we have restaurants leaving the market, then we have a supply function that is going to shift to the left as well. So now we have restaurants dropping out. So we have the supply during the pandemic. And now this leads to a new price where we have the pandemic supply and pandemic demand, where we have in general lower quantity of restaurants, and we do have a stabilization of the price for those restaurants that are still remaining in the market. Okay? Now, if you think this through and you're starting at the equilibrium, which is during the pandemic, where you do not have a lot of restaurants in the marketplace anymore, then if the economy opens up again due to vaccinations, then we are going to have the reverse, where we then have a shift in the supply, in the demand function. The demand function is going to go back to, say, maybe the original level, okay? And so in the short run, you would have a spike in the price of restaurant meals until more restaurants find it profitable and enter the market to restore somewhere close to the old equilibrium, okay? Now note when I say restoring something close to the old equilibrium, that this is a hypothesis and it may or may not be true. This is to see over the next couple of months and years. Okay? So this is an illustration of the concept of supply and demand. The COVID-19 pandemic is of course not the first pandemic the world has ever witnessed. In 1918, we had the flu pandemic or the influenza pandemic. And when you look at what happened during that pandemic, you see parallels to what happened today. Note that the following quotes are out of the working paper called Economic Effects of the 1918 Influenza Pandemic, and that it was actually written in 2007. Okay. Now, in 1918, we had a lack of economic data, but you can still see of what the various newspapers in parts of the country are writing. So, for example, a newspaper in Arkansas said that merchants in Little Rock say their business has declined by 40%. Some even say by 70%. Note that the treatment for influenza at the time was bed rest, and which has increased the demand for beds, mattresses, and springs. You also had effects on mines throughout East Tennessee and Southern Kentucky, in the sense that workers got sick and could not go to work. Now, how did the 1918 influenza actually influence the labor market? You will see that there are parallels to today. So in the initial situation, we have a labor market in equilibrium. Note that when I talk about the labor market, then this is very similar to what we have seen before about the market, for example, for milk or the market for restaurant meals. Then the market for labor is very similar in the sense that you have a supply of labor. That supply is provided by workers, and you also have a demand for labor, and that demand is provided by the firms. Now, the impact of the flu led to a reduction in the labor supply because people got sick, and it turned out that that increased actually the wages because the labor was not mobile. And research has shown that there's a greater increase in manufacturing wages in cities where the influenza mortality was higher. Note that this also assumes that there was no effect on labor demand, in the sense that firms still continued to hire workers. Now, let us illustrate this graphically of how this looks like in a supply and demand graph. Let us illustrate what we just said in a graph. Here, I have depicted the equilibrium situation of the labor market. We have the demand of workers, which is from the firms. Okay, so firms or companies, they have a demand for workers in the sense that if the wage is high, then they're demanding fewer workers, and if the wage is low, then they're demanding more workers. The inverse is true for workers, then in the sense that if the wage is low, workers are not willing to supply their labor force to the market, whereas if the wage is high, workers are more willing to supply their labor to the market. And in the initial situation, we have an equilibrium price and we have an equilibrium quantity. Note that in this case, the equilibrium price is the wage that is prevailing in the market. Now, in the case of the 1918 flu, what happened is that we had a reduction in the labor supply, okay, in the sense that we had a supply because now workers were getting sick or dying. We have a shift to the left of the labor supply. So now we have supply with the flu. And you can see that this results in fewer workers being available on the market. Let's call this Q prime. And we also have the increase in wage. Let's call it W prime, that was actually observed in the areas where there was a higher flu mortality and where the manufacturing wages grew more above average than anywhere else. Okay, so here again, with a very simple supply and demand graph, you can illustrate the impact of the 1918 flu on the labor market. Now, let us have a look at the macroeconomic indicators. And some of those macroeconomic indicators you may have heard talking about in the press. And what I want to show you is to put the magnitude of the shocks triggered by COVID-19, to put those shocks into a perspective, and also to show you a little bit of where you can get the original data. Now note that most of the graphs that I'm about to show you is coming from the FRED, or the Federal Reserve Economic Data webpage, which I have shown you before. So here you can see the unemployment rate in percent in the United States from January 1948 to April 2021. You can see that when the pandemic hit, that unemployment spiked to almost 15%, which was by far the largest shock since many decades. But you see that you also still have the unemployment rate has come down in recent years, and we are going to talk about this later when we are actually talking about the labor shortage. As you may have heard, there are a lot of newspaper articles that talk about a labor shortage, but note that despite the fact that there is this apparent labor shortage, that the unemployment rate is still not yet at the pre-pandemic level. In a sense, you still have people that are unemployed from the pandemic and are not yet in the labor force. And I'm going to come back to this. Let us have a look also at the unemployment rates for other countries. Note that the shocks caused by COVID-19 are very similar in other countries as well, in the sense that you suddenly have a decrease in demand, you have lockdowns, etc. Now note that in European countries, what happened is that people did not get laid off from their work, but many countries actually have legislation that allows workers to reduce their work hours, including their pay. So they are working less and they're also receiving less money. Also, there was a lot of money, pass-through money from the government, where the government gave money to companies and the companies were able to give that money to pay wages for their workers. Note that you have to be careful because some of the statistics may also be a little bit misleading. You will see that in Italy, you actually see a drop in the unemployment rate at the beginning, which is actually caused by workers being discouraged and they simply dropped out of the labor force due to the pandemic. So here you have this graph and the data comes from the OECD, or the Organization of Economic Cooperation and Development. And you can see that you have the United States, that there's a very large spike in the unemployment when the pandemic starts to hit. Also, the same is true for Canada, which had a very large spike. And you see that the Euro area, that the unemployment increased only by a little bit, but it still remains at a high level, okay? And I have also included the dip in unemployment here in Italy as well. Now, we have seen in the previous year that the lockdown changed retail sales in the sense of how did people spend money on food services and drinking places, think about restaurants and bars. And basically, they switched from going to those places because they were closed, and they are purchasing more at grocery stores. Now, let me first explain the difference between those two graphs. Note that both graphs more or less display the same type of information, right? In the sense that they represent changes in retail sales for the United States for the categories that you see here at the bottom. Now note that what you see over the year, that when you're looking at monthly data, that you have what is called seasonality. Think about the following. In December, you have the holiday seasons, and hence a lot of people are going to spend a lot of money on retail sales or in retail stores. For example, because they are purchasing more food, they're purchasing presents, etc. Now, when you're comparing December to January, then you see this large drop in the retail sales because people have spent a lot of money in December and now they are basically cutting back in terms of spending in January. So you see within a year, you have fluctuations from month to month, and those fluctuations are very predictable, and they're called seasonality. Now on the left-hand side, where it says not seasonally adjusted, you have those US retail sales for the various categories, and this is the raw data, in the sense that this represents the month-to-month changes from retail sales. Now, usually, in order to get a better picture about how a time series evolves over time, there are methods to take the seasonality away from the data, okay, or to correct for the seasonality. And this is done on the right-hand side, where it says seasonally adjusted data. And what you can see is that, so if you take out the seasons up to so before the pandemic, you have small changes in the retail sales, and then when the pandemic hits, you see that people stopped going to restaurants, which is the red line. Okay, here the food services and drinking places. Because you had stay-at-home orders, people did not spend much anymore on gasoline. However, retail sales at the grocery store, okay, this is the blue line here, they spiked because people had to switch from going out to restaurants, they now had to cook at home. And hence they went to the grocery store or who had a grocery delivered. Now, note that the retail sales in general also decreased, but not as strong as for gasoline stations or for food services and drinking places. Just to give you a little bit about the historic perspective of the retail sales shock caused by COVID-19. So here we have data from 1992 all the way to April 2021. Note that this is seasonally adjusted data. And you can see that the biggest changes in terms of retail was for gasoline during the 2008 recession. Okay, here you have this sudden drop. Also note that gasoline stations, or the money spent in at gasoline stations, fluctuates significantly. And we will be coming back to those fluctuations. But if you take out the gasoline stations, you can see that the retail sales are relatively predictable. And it is only in the during the COVID-19 pandemic that you have suddenly these huge fluctuations. Now, when you also have this change in the consumption pattern of consumers, this also has an impact on the gross domestic product, or GDP. Note that the gross domestic product measures the income or the economic performance of a country. Or better, it measures the size of the economic sector. And you can see that, note here we have data from various countries, okay? And here again, the source is the Organization of Economic Cooperation and Development, OECD. And you see that we have this decline when the pandemic hits, and then you have this effect of bouncing back, because what people did not spend here, they're going to shift their consumption into the future, okay? Note that if you take, for example, India, that it had a very large contraction of the GDP, but that in the quarter afterwards, it also had a significant increase in GDP of almost of over 20%. Now let us look at the policy responses for the COVID-19 pandemic. Note that we are going to look at two large groups of policy responses. The one is fiscal policy and the other one is monetary policy. Fiscal policy is conducted by Congress and the executive branch, for example, the White House. Examples here are the Coronavirus Aid, Relief and Economic Security Act, or the CARES Act, which was enacted last year, and the amount that was spent was about 2.2 trillion US dollars. And we also have the American Rescue Plan Act of 2021, and there the sum spent was $1.9 trillion. Monetary policy is conducted by the Federal Reserve, or Fed for short. Note, and this will become important soon, the dual mandate of the Fed states that the Federal Reserve has to ensure maximum employment and price stability. Price stability means low inflation. The current target of the Federal Reserve is an inflation rate in the long run of 2%. We will see that the Federal Reserve tolerates higher inflation rates, meaning above 2% in the short run, but the long run average should be 2%. If you're interested in policy responses by other countries, note that the International Monetary Fund has this webpage that lists all the policy responses to COVID-19 by various countries. So if you are, for example, interested in the COVID-19 response by, say, Japan, then you can look on J, and you find here information about how Japan responded to the COVID-19 pandemic. So let us first look at the CARES Act and also the American Rescue Plan Act. Note that the CARES Act was implemented by then President Trump, and the American Rescue Plan Act was implemented by President Biden. Now, what both acts do, or the purpose behind both acts, is that the government spends money when firms and individuals cannot in order to support the economy. This is the reason why both acts included household payments, lump sum payments to individuals below a certain income threshold of $1,200 for the CARES Act and $1,400 for the American Rescue Plan Act. Also note that both acts extend the unemployment insurance in the sense that the CARES Act gives individuals an additional $600 per week. Note that that expired in July of 2020. And the American Rescue Plan Act still gives individuals that are on unemployment an additional $300 per week. Okay. Now, the question is, what are the impacts of this fiscal policy? Okay. So note on one side, or part of the responses from the federal government in terms of fiscal policy was also what I call the Paycheck Protection Program, which basically gives loan to small businesses, which can then convert those grants to be used for payroll or paying workers. Now the question is, if you have the federal government spending a lot of money on the protection of the economy, what exactly are the consequences of that? First, you are interested in, well, what does it do in terms of deficit and debt of the federal government? So note that the federal government in 2020 had a budget deficit of a little bit over $3 trillion, which represented 14.9% of the gross domestic product, okay, or of the economic performance of the US. Note that when you're looking at the countries that are forming the Eurozone or the Euro area that are using the currency, that many years ago in the 90s, when they actually decided to establish the Eurozone, that they said that countries within the Eurozone should not have a deficit of more than 3% of GDP. Okay, so here you have for the US, you now have a deficit of 14.9%, and note that in the European Union, those numbers are going to be very similar. Deficit is the difference between revenue and spending in a given year. And note that the debt is the accumulation of deficits. Okay. Now, in the first quarter of 2021, the total public debt of the United States was 127.5% of GDP. Okay. Now, note again, coming back to the countries in the Eurozone, when they established the euro, they agreed that the percentage of GDP that is debt should not exceed 60%. And again, given the COVID-19 pandemic, those numbers have been exceeded by a lot. Now, you do have the consequence of the fiscal policy on deficit and debt, but you also want to know how does the fiscal policy or the stimulus spending, how does it actually affect GDP? Okay, and this is what you need to know here is what is called the fiscal multiplier. So a multiplier of 1 implies that for every dollar increase in GDP, there's a $1 increase in GDP from every dollar spent on the stimulus spending. Now, what you need to know in order to calculate the fiscal multiplier is what is called the marginal propensity to consume. Think about when you're getting an additional dollar of income, or if you're getting additional money for your income, if you're getting additional income, how much of that additional income are you actually going to consume? So there are estimates from the literature where it says that the fiscal multiplier can range between 0.34 all the way up to 2.03. Okay, and that if it's actually spending from the government, that the multiplier can be 1.5. Note that overall there are key similarities between the Great Recession stimulus spending and the COVID-19 stimulus spending. Now, the next graph is going to show you how the US response compares to the international response. Again, this is data from the International Monetary Fund, and it displays the additional spending or the stimulus spending, which is marked in the red bars, and it also includes equity loans and guarantees to firms that are not directly spending, but that are credits or loans to companies. Okay, so what you can see, what I found interesting is that if you are looking at countries like the United Kingdom, the United States, Singapore, New Zealand, Australia, Canada, basically English-speaking countries, that they relied mostly on additional spending, okay? In a sense like the stimulus spending. Whereas if you're looking at many European countries, Czech Republic, Denmark, Germany, Italy, that they relied on equity and loans, okay, instead of stimulus spending. A second way to influence the macroeconomic environment is so-called monetary policy. Note that monetary policy is conducted by the central bank. In the United States, that would be the Federal Reserve. In the European Union, that would be the European Central Bank. The central bank, through monetary policy, regulates the supply of money. Now, note that the price of money is the interest rate. If the interest rate is very high, think about if you want to purchase a car or if you want to have a mortgage on your home. If the interest rate is very high, then you are paying more to get the loan. Now, the Federal Reserve Bank of Atlanta has a very interesting video on YouTube that explains monetary policy. I highly recommend that you are watching this video, and the link is provided in the comments. There are multiple tools to conduct monetary policy. There are open market operations, there's the discount rate, and there are also reserve requirements. All of those tools, the purpose of all of those tools is to regulate the supply of money in the market. With open market operations, the central bank is purchasing securities from commercial banks, or they are selling securities to commercial banks. They also use the discount rate, which is basically the interest rate charged to commercial banks and other depository institutions on loans they receive from the regional Fed lending facility. Again, via the discount rate, the Federal Reserve Bank determines the price of money, and hence they can influence the money supply. If the interest rate is high, it reduces the supply of money. If they lower the interest rate, they are increasing the supply of money. If interest rates are low, then this stimulates the economy because loans or credits are getting cheaper. Think about, you're more likely to purchase a new car if you're getting a low payment on your car loan. Also, the third tool are what are called reserve requirements, which basically are requirements that the Federal Reserve sets of how much money banks, commercial banks, need to have in their vaults. If they are reducing this reserve requirement, that increases the supply of money. Now, during the COVID-19 pandemic, the Federal Reserve has taken several measures. They have lowered the interest rate. They have lowered the interest rate to 0 to 0.25%, which is called the zero lower bound. Okay? They basically exhausted that policy tool because they cannot get lower. They have also engaged in large-scale asset purchases, and this type of policy is called quantitative easing, or QE. In the last section of this lecture, we are going to look at recent economic developments that you may have heard in the news. One of the biggest topics in the news right now, apart from the progress in vaccination, is fear for inflation. The Wall Street Journal noted on May 13th that consumer prices jumped as economic recovery picked up. The same day, they also said the index, here they mean the consumer price index, rose 4.2% from a year earlier, biggest 12-month increase since the summer of 2008. CNBC noted that inflation speeds up in April as consumer prices leap 4.2%, fastest since 2008. Now, we are going to look a little bit behind the number of 4.2 and what causes inflation and how big of a problem it is going to be. Note that the big question right now is whether inflation is temporary, in the sense that we now have a price increase, but then very soon we are going to see a price decrease again, or a leveling off of inflation, or if the inflation is permanent, in the sense that we are going to start a phase where we have a permanent increase in prices. Now, what is interesting is that the British magazine The Economist on April 18, 2020, so over a year ago, noted that inflation seems unlikely until perhaps the world's struggle with COVID-19 nears its end. So, what is inflation and how do we calculate inflation? A core concept to calculate inflation is what is called the Consumer Price Index in the United States. The CPI is a measure of the average change over time in the prices paid by urban consumers for a market basket of consumer goods and services. Note that here we have the term urban consumer, that urban consumers represent about 87% of the US population. Now think about the CPI as follows. You go into a supermarket, say Kroger, and you are filling the shopping cart with a lot of items, and you're going to the checkout and you determine the price. Now, a month later, you are doing the exact same thing. You are purchasing the exact same items, and you are going to the checkout, and then you can compare what you have paid a month ago for those items and what you're paying today. Now, the CPI is doing very much the same thing, but it is using a basket of 80,000 items. There are weights in that basket, so about food and beverages are about 15%, housing is about 43%, apparel is about 4%, transportation is about 17%, and so on. And based on how the CPI evolves over time, the change between values is what determines the inflation. However, you have to differentiate between what is called headline inflation versus core inflation. Headline inflation is what we have seen before, the number of 4.2% that was mentioned in the Wall Street Journal as well as the news CNBC, among various other media outlets. The 4.2% is headline inflation. Now, it turns out that food and energy prices are very volatile over time. Think about bad weather destroying a crop harvest and the subsequent decline in crop yields, or think about fluctuations in the oil supply triggered by OPEC. Now, if you have fluctuations in the oil supply, that also translates into fluctuation in the price. Thus, economists usually exclude those items, food and energy, and when you exclude food and energy from the CPI, then you are getting what is called core inflation. Okay. Now note that the 4.2%, as mentioned before, includes food and energy prices. So in April of 2020, the CPI was at 256.192. In April of 2021, it was at 266.832. The difference between the two is the 4.2%. Now, to illustrate graphically or visually the difference between the headline inflation and the core inflation, I have plotted those numbers from 2005 or January 2005 all the way to April 2021. Note that the red line represents the headline inflation and the blue line represents the core inflation. And you can see that the core inflation is much less volatile than the headline inflation, where the headline inflation includes food and energy items. Now, let us look at the consumer price index and note here that I have plotted the consumer price index for all items and for all items less food and energy. Note that there are two things to notice or to note on this graph. First of all, it is very bad practice to not start at zero on a graph, but here to illustrate the concept, I have made this faux pas, and I am starting at I'm displaying the chart in a very narrow range. Second, we are talking about an index, so do not worry about the difference between the two lines. Okay, so the difference here is not really of importance. Now, what you should be noticing is that the headline inflation, which was mentioned in the headline inflation mentioned of 4.2% in the articles, that was the difference between April 2020 and April 2021. Now, when you look at the data, then what you see is that when the COVID-19 pandemic actually started to hit, that you had a decrease in prices. So it turns out the 4.2% increase is measured at the low point here and the high point. Now, there's little doubt that the CPI has accelerated over the last couple of months, but note that the 4.2% reflects a base problem in the sense that you have a dip in the CPI, and hence when the CPI increases, that you are measuring from a very low base. Okay, so the number of 4.2% is probably a little bit exaggerated. Okay, note that we will see that the inflation or the acceleration of the price level in the United States is still on the radar of the Federal Reserve and also policymakers, because it does indeed increase by quite a bit. Okay. Now note that the Federal Reserve does not focus on the core inflation or on the core CPI, but it is actually measuring a slightly different, or it's using a slightly different measure, which is called the Personal Consumption Expenditure Index. Okay. Now you can read what I have here on the slide, but think about the PCE, this Personal Consumption Expenditure Index, just as a slightly different measure compared to the CPI. It turns out that in the year 2000, the Federal Reserve actually said that when they are focusing on inflation, that they are now more heavily focused on the evolution of the PCE as opposed to the CPI. And note that for April 2021, the Personal Consumption Expenditure Index actually increased by 3.1%, which is still very high. Now, note that in the previous lectures, when I talked about monetary policy, I also said that the Federal Reserve has a long-term inflation target of 2%. Okay, so here we have this inflation of 3.1%, which means that this is above the target of the Federal Reserve Bank, and hence the concept or the issue of inflation is on everyone's radar. Now, let us look at the causes or the mechanics behind this increase in price level or inflation. The big question is whether the current inflation that we are observing, if it's temporary or transitory, or is it permanent inflation? Think about inflation as too much money chasing too few goods. Okay, or that there is an excess in demand and hence prices are increasing. Now, there are a few aspects that would indicate that it's a transitory inflation. Here, the first is about the unleashed demand due to vaccinations and fewer cases of COVID-19, where the economy has been in a lockdown for over a year. People have not been spending a lot of money, or for example, they have not been able to go to restaurants or to vacations. And it is very difficult to turn on the economy, so to say, from one day to the next. You have a lot of demand and you do not have a lot of supply. Now, remember that there have also been supply chain disruptions about workers getting sick in factories or manufacturing, and hence there was a decrease in output, and now it is very difficult to restart the supply chains and fix those disruptions. The argument of those who believe that the inflation is temporary, they say once the supply chain disruptions have eased, then the inflation will be back to normal levels. We are going to talk about shortages of labor as well. Remember that we still have an unemployment that is above the pre-pandemic level. And hence, once the labor force is back to previous levels or back to pre-COVID-19 levels, we may have more supply and hence the inflation would be temporary. On the other side, there are some indications that the inflation may be permanent. For once, we have a large stimulus spending by the federal government. And note that you have the same type of stimulus spending also in other countries as well. And the European Central Bank has also posted very high inflation rates in recent days. Also, there's a general excess in savings during the pandemic for some income groups. There were usually high income groups that were able to save a lot of money, and now they are going to spend this money in the future. A third, which I have not listed here, but is also very important, is a very low interest rates, in the sense that I mentioned that before, that the Federal Reserve and also the European Central Bank, they have very low interest rate, which makes money very cheap, and it makes it also very easy to get a credit. But note that this low interest rates is also something we have already observed before the pandemic. Now, there are also other considerations when we talk about inflation. Usually, economists think about three different considerations. First, we have supply shocks. This is what I mentioned before, where we have too much demand for and supply is simply not ready to meet the demand. We have seen this also in the 1970s, where we suddenly had this oil price shock. Another important consideration is the extent to which the economy is operating above or below capacity. Remember that inflation is too much money chasing too few goods. If the economy is operating at capacity, then there is no room to produce more in order to meet the demand. However, if the economy is operating below capacity, then even if we have a temporary increase in demand, once the economy can move closer to capacity, this increased demand is met with supply and the inflation is going to decrease. Again, there's a large number of people that are still unemployed, and economists talk about the relationship between the inflation and unemployment of the Phillips curve, in the sense that there's an inverse relationship between employment or unemployment and the inflation rate. Now, the last point is very important, and that's the expectation about inflation. What I mean by this is that consumers form expectations or beliefs of how the price level is going to be in 6 months and a year from now. And once they're building those expectations into, for example, wage negotiations, they're asking higher wages for their work, then those higher wages also going to lead businesses to increase their prices. Okay? Think about this as a self-fulfilling prophecy. The same is true if you are a business and you are expecting input prices for your goods to increase over time, then you would adjust prices today for your output products, which also would increase inflation. Okay? But note that this could lead to what is called a self-fulfilling prophecy. There are indications from a survey at the University of Michigan that is asking consumers of how they think prices are going to evolve over the next couple of months. And recent results of this survey indicate that consumers do indeed expect higher prices, in the sense that they're already building the expectations of higher prices into their decision making. Now, let us look at a more concrete example about higher prices. And here you're going to talk about lumber prices, and I'm sure you have, if you're reading the news, you have heard about this. So it turns out that the pandemic has triggered a different pattern in consumer spending when it comes to lumber. Usually when you have a normal recession, think about 2008, 2009, you have a decrease in housing and home improvements. Now, the COVID-19 recession was different. You had an increase in home improvements due to stay at home, and you had lockdown policies. So what happened is, and here this is data I have pulled from the Federal Reserve economic data. Note those are housing permits or housing permits issued. So you see that at the beginning of the pandemic, housing permits decreased significantly. So here in this case, sawmills and lumber suppliers thought that they are in a normal recession where home improvement housing is going to decrease, and hence they were significantly reducing capacity, and they were also clearing out their inventory. However, what happened is you now have people staying at home. They are starting to do home improvement jobs and also think about all the lumber that is used to build outdoor seating areas due to COVID-19, that actually increased significantly the demand for lumber. Well, sawmills and lumber suppliers, they cut back their capacity, they cleared out the stock, and suddenly they are hit with a lot of demand, and hence you have this increase in lumber prices. Now, another aspect of the COVID-19 pandemic and the increase in prices are housing prices. In the US, as well as globally, or in Europe, there have been a significant increase in housing prices. People want to get out of their apartment and they're looking for homes. You also have very low interest rates that increased the demand for housing. Now, what is interesting is that so far, there is no increase in rents or in rental prices. Usually, housing prices and rents are moving together in the long term, but we have not seen this so far. Now, here the important aspect is that housing prices are not part of the inflation calculations. However, rents are. So once the rents are increasing, then you also have, and since they are a large part of the consumer price index calculations, then once the rents are increasing, that also is going to translate into an increase in the consumer price index and hence inflation. Okay? Now, the last topic is about labor shortages. Note that here I have created some headlines about the recent labor shortages. So you have the New York Times saying the myth of labor shortages. You have Biden's American Rescue Plan unemployment benefit extension making it difficult to find workers, employers say. You have the worst worker shortage ever. And we also have from The Economist why American workers becoming harder to find. Now, the first headline here from the New York Times says, from a very economic standpoint, says, there is no labor shortage. The only problem is that firms are not willing to pay higher prices or higher wages. Once firms are willing to pay higher wages, then the labor shortage goes away because people are going to come to work. Now, although this is true, think about what this would do actually to potentially do to prices, because some of the higher labor costs firm would have to put on the consumer. Now, some of the explanations for the labor shortage is given by two factors. On one side, we have unemployment benefits. As mentioned before, last year we had $600 of additional unemployment benefits per week. Today we have $300, and hence the argument is that companies are competing with the federal government for labor or for the labor force. Not that the federal government would employ them, but that the federal government pays them a sufficient amount of money in the sense that it is better to stay at home instead of working. Now, another argument is also fearful workers, that you have high rates of job openings in the healthcare and hospitality sector, but you actually have low rates in the construction sector. Because in the healthcare sector and hospitality sector, you have a lot of one-on-one interactions with consumers or customers, and hence you have a higher chance of getting infected. And you do not see that in the construction industry. Now, let me just finish by saying that the economic aspects of COVID-19 are very, very complex. There are a lot of interactions going on, and what I urge you to do if you hear any argument is to dig a little bit deeper. Most of the times, easy answers seem very reasonable or very intuitive, but very often they are not. There are many other things that are going on. Think about the topic of inflation, whether it is temporary or permanent inflation. One of those sides who are arguing whether it's temporary or permanent is going to be true, is going to be right or correct at the end. But we cannot know that. We cannot know that right now. There are a lot of things, or there are a lot of indications that it is a temporary inflation, but there are also a lot of indications that it may be permanent, and only time will tell. Well, thank you very much, and if you have any questions or comments, please feel free to contact me.